We've been asking people going into the next year, do you have any convictions, or is it going to be a year of trying to agilely manage your way out of volatility? But you actually are very optimistic.
Yes, thank you for having me. Good morning. We feel like this vintage of investments that's coming up is actually going to be a really good vintage for private equity investors. We're more of a controlled buyout investor, so we haven't been sort of caught up as much, I'd say, in the bull market bubble that we saw over the last couple of years. We're more focused on buying controlling stakes in companies, creating value in the businesses through the changes that we make to those businesses, putting in great leadership teams, and then managing those businesses for change and growth. And we think that the current environment presents an interesting entry point because valuations have come off so much.
Certainly not struggling to fundraise, $11.2 billion in September. That's really in contrast to particularly a lot of the smaller shops that have really struggled.
Well, I think private equity is proving to be a haven in these kind of volatile markets, and I think large established players like our firm and others are attracting capital because of the way that we invest and the way that we drive value creation, somewhat independent of the economic cycle. We're not totally independent of the economic cycle, but we're able to make money in good markets and in bad markets. And so I think the industry is consolidating a bit. In fact, that's probably one of the key drivers of our decision to combine our firm with EQT, is to be part of this industry-wide consolidation, where you're going to have global scale firms like ours that have global sector capabilities, that have global teams, that have the ability to invest in technology, to invest in sustainability initiatives. And so we think scale is going to be an increasingly important factor. And investors are also limiting the number of investors of funds that they invest in and sort of concentrating their capital in fewer and fewer GPs. So that's a trend that I think will continue.
We're seeing tech being challenged now on rising rates and perhaps the different macroeconomic picture that we have. So when you have all of that capital, what do you like?
Well, there has been a big reset in valuation. So right now, if you look at the public markets, they're up 25, 35%, depending on how you look at it across the region. So it's a question of the sector fundamentals versus the entry price. And I think right now, a number of sectors still have strong fundamentals. The two sectors that we focus on the most are technology and healthcare. And we're still seeing a lot of interesting macro long-term structural growth trends in both of these sectors. And in terms of entry price, I think it varies country by country within the region. But there are some interesting take-private opportunities at the moment where you have public companies whose stock prices come off, and where it really makes more sense for those businesses to be privately held now and to grow through this volatile period as a private company and then perhaps relist in 3 or 4 years' time. There's also companies that are able to take advantage of the current environment to consolidate their market position by acquiring other companies. And so we provide that capital to help companies consolidate and do what we call bolt-on acquisitions to grow their scale and then combine with other businesses to increase their competitive position.
With COVID-0 in China going on forever, perhaps some restrictions being loosened a little bit right now, we have heard everything about the Chinese markets, from the uninvestability of that space. What do you think?
Well, I've been living in Hong Kong since 1989. I started investing in China in the 1990s, and I can tell you that in the 1990s, China was uninvestable. So today's China is nothing like it was in the 1990s. It's much more investable than it ever was in the past. I think what's changed is that the way that you invest in China is continuously evolving. So I think you need to look at the areas where China has competitive advantage. There are certain areas where China really dominates. Number one, they have tremendous renewable energy scale now in terms of green energy. Secondly, it's a country that has tremendous amounts of innovation and technology. So there's lots of R&D centers being created and built in China that will drive further innovation. And third, I'd say China's just got tremendous scale as a domestic market. And so I think looking at China not so much as a place for low-cost manufacturing, but looking at it as a place where there's innovation, where you can drive scale in domestic companies, and where you can use the green energy that's available in the economy. Those are some of, I think, the fundamental forces that continue to make China an interesting market. So from our perspective, we remain very positive on China. I think the regulatory changes that have taken place have caused people to pause and wait for the dust to settle a little bit. But I think now we're starting to see more clarity, and I was really happy to see how warm the initial meeting between Xi and Biden was yesterday, and how they sat down for 3 hours together, because I think ultimately these are the two largest economies in the world. They have to figure out a way to work together. They're so interdependent. So I believe that there's going to continue to be opportunities, and that the two countries will figure out a way forward.
So, John, are you actually currently investing along those narratives of the energy transition, of tech opportunities in China, or are you waiting to kind of potentially increase exposure as the policy outlook becomes becomes a little clearer?
I'd say it's more the latter, that I think we continue to look at the environment carefully. We have a large team in Beijing and Shanghai. We've been making investments in China historically. We've sort of been slowing that down at the moment to see how the policy changes affect the outlook. But I'm pretty confident that the direction will be more clear as things progress here.
What's the catalyst, though? Number one.
I think the recent Party Congress was one catalyst. The next Party Congress in March will probably be another catalyst. And I think just getting a little bit more clarity on policy direction, starting to see some opening up of the markets for the stock markets for IPOs again, for public market investors. I think those are some of the things that will help us get more confidence.